A common way to accelerate accounts receivables collection is a sale to a factor. A factor is a finance company or a bank that buys a receivable for a fee. Factors collect the payments directly from the customers, and their factoring fees can range from 1 to 3% of the amounts of the receivables purchased. The company usually sells its receivables. It will record the service charge as a selling expense. The company sells its receivables infrequently. It may report the fee under other expenses and losses in the income statement. So let's assume that Hendredon Furniture factors $600,000 of their receivable to Federal Factors. Federal Factors assesses a service charge at 2% of the amount of receivables sold. The journal entry to record the sale by Hendredon Furniture is first we take the $600,000 and multiply it by the 2% to determine that there is a $12,000 service charge. So we won't receive $12,000 of the $600,000 in receivables that we're going to sell. We'll get $588,000 from Federal Factors. Recognize $12,000 of service charge expense. We would reduce our accounts receivables by $600,000. Approximately 1 billion credit cards are recently in use. A common type of credit card is a national credit card, such as Visa, MasterCard, Discover, American Express. There are 3 parties involved when national credit cards are used in making retail sales. You have the credit card issuer, who is absolutely independent of the retailer. Then you have the retailer, and then you have the customer. A retailer's acceptance of a national credit card is another form of selling or factoring the receivable by the retailer. There are several advantages of credit cards for the retailer. The issuer does credit investigations of the customers. They maintain the customer's account. They undertake the collection process and absorb the losses. And the retailer receives cash more quickly from credit card issuers. In exchange for these advantages, the retailer pays the credit card issuer a fee of 2 to 4% of the invoice price for its services. Sales resulting from the use of national credit cards are considered cash sales by the retailer. Upon receipt of credit card sales slips from a retailer, the bank that issued the card immediately adds that amount to the seller's bank balance. So to illustrate this, let's look at Morgan Marie, who purchases $1,000 of compact discs for her restaurant from Sondereth Music Company, and she charges this amount to her Visa First Bank card. The service charge that First Bank charges Sondereth Music is 3%, and Sondereth Music's entry to record the transaction on March 22nd is going to be cash of $970. That is $1,000 less the $30 3% charge that Visa First Bank card will charge them. And sales revenue of $1,000. So here we have a little bit of information for you on how credit cards work. Now, this talks about the magnetic stripe on the back. This is also the same now for the chip cards, except for the chips are considered more secure. If you haven't finished reading this, please feel free to hit pause and then start again when you're ready. We're going to look at factoring just one more time. With Peter M. Kell Wholesalers, who need to raise $120,000 in cash to cover Friday's employee payroll. They have reached their debt ceiling. They cannot borrow money from anybody. Their present balance of outstanding receivables is $750,000, so they decide to factor $125,000 of it on September 7th, 2017 to alleviate this cash crunch. So we're going to record the entry that they would make, assuming a 1% service charge. If we take $125,000, multiply by that by 1%, then we are going to get a service charge of $1,250. That means we will receive $123,750 in cash. There will be a service charge expense of $1,250. And then accounts receivable of $125,000 that we will no longer have because we will have factored them to another company. Now we're going to look a little bit more at other types of dispositions, other issues that might come into play. So companies may grant credit in exchange for a promissory note. This is a notes receivable. Promissory note is a written promise to pay a specified amount of money on demand or at a definite time period. Promissory notes may be used when individuals and companies lend or borrow money, when the amount of transaction and the credit period exceeds normal limits, or in the settlement of an accounts receivable. In a promissory note, the party making the promise to pay is called the maker. The party to whom the payment is being made is called the payee. The payee may be specifically identified by name or may be designated simply as the bearer of the note. Notes receivables give the holder a stronger legal claim to assets than an accounts receivable. Notes receivables, like accounts receivables, can readily be sold to another party. Promissory notes are negotiable instruments and are frequently accepted from customers who need to extend the payment of an outstanding accounts receivable, and they often are required from high-risk customers. There are 5 issues in accounting for notes receivables, and we'll go through some of these here shortly. Determining the maturity date, computing the interest, recognizing the notes receivable, valuing it, and then eventually disposing of the notes receivable. So let's start with determining the maturity date. The maturity date of a promissory note may be stated in one of 3 ways. It could be on demand, it could be on a stated date, or it could be at the end of a stated period of time. When life is expressed in terms of months, you find the date when it matures by counting the months from the date of issue. When the due date is stated in terms of days, you need to count the exact number of days to determine the maturity date. When you're doing that counting, omit the date the note is issued, but include the due date. The second factor, computing interest, actually has a basic formula attached to it. That is face value of the note or principal multiplied by the annual interest rate, because the rate that we are being given is interest. And then we multiply that by time expressed in terms of 1 year. So if we are 120 days, then we do 120 divided by 360. Or if we are 6 months, we are 6 out of 12 months. And we give the fraction of time to determine how much interest there is. Many financial institutions do use the 365 traditional day of the year. In your text, though, it is using a 360-day year. That is 12 months, 30 days each month. This is something that's a little bit of an artifact from a historical way that things were being done for a while. Now the lending and banking institutions have moved to a 365-day year. So let's see what Brent Company does when they need to recognize their notes receivable. Notes receivables are recognized at their face value. The value is shown on the face of the note. The basic entry for this particular issue with a $1,000 promissory note is notes receivable, 1,000, and then they would reduce the accounts receivable, 1,000, assuming that this is to settle an open account. We do not report our interest when the note is accepted because revenue recognition principle does not recognize revenue until it's actually earned. Interest will be earned or accrued through time as time passes. Short-term notes receivables are reported at their cash net realizable value. The allowance account to notes receivables is the allowance for doubtful accounts. There is an estimation of the cash realizable value, and there is also a recording of any bad debt expense, similar to that of accounts receivables. There is a lot of net realizable versus fair value versus historical value controversy between FASB and IASB. This is something that will take a long time for the two parties to come into agreement with one manner that they feel would be best. Notes may be held to their maturity date, at which time the face value plus any accrued interest is due. In some situations, the maker of the note is going to default, and there's going to be an appropriate adjustment made by the payee. Makers can speed up their conversion of notes receivables to cash by selling their notes receivables to another party. A notes receivable is honored when it's paid in full at maturity. For each interest-bearing note, the amount due at maturity is the face value of the note plus interest for the length of time specified on the note. A note is dishonored if it is not paid in full at maturity, and dishonored notes are no longer considered negotiable instruments. Let's look at Wolder Company, who lends Higley $10,000 on June 1st, accepting a 5-month, 9% interest note. If Wolder presents the note to Higley on November 1st, the maturity date, their entry to record the collection would be $10,375 in cash. That represents the $10,000 in notes receivable and $375 in interest revenue. That is 9%, or that is 10,000 multiplied by 9, multiplied by 5, divided by 12. Now let's suppose instead that they prepare the financial statements on September 30th. The adjusting entry for Wolder at the 4 months is that there would be interest receivable. We expect to receive interest of $300 that we have earned on this note. That is 10,000 multiplied by 9% multiplied by 4 divided by 12. We use the account interest receivable. We do not post it to the notes receivable account. Now, on November 1st, when the note is honored, we'd receive cash at $10,375. We'd have notes receivable of $10,000. We would have interest receivable of $300, and then an additional $75 of interest revenue that had not been recognized yet.